there's still $300-ish billion left in the coffers from the handouts from a couple of years ago. And credit card debt. I mean, credit card debt has gone absolutely, I think it hit $1 trillion for the first time. I think I have that stat right. So I just totally missed the fiscal part, that the government was going to spend their way into oblivion and not worry about the devaluation of the currency, which is why Larry Fink went on TV and said, maybe you should own some Bitcoin. You should buy it from me, but you should own some Bitcoin to protect yourself against currency devaluation. Come on. He said that on television.
Any thoughts that the 2% inflation goal long sought by the U.S. Federal Reserve and the European Central Bank might be in for tweaking were dashed on Friday by the chiefs of the two institutions, gathering in Jackson Hole, Wyoming for the annual Federal Reserve Bank of Kansas City Economic Symposium. Both Fed Chair Jerome Powell and ECB President Christine Lagarde made plain their views. There will be no change to central bankers' shared objective of getting inflation back down to 2%. 2% is and will remain our inflation target, Powell said in his keynote address. We are committed to achieving and sustaining a stance of monetary policy that is sufficiently restrictive to bring inflation down to that level over time. Inflation soared around the world as economies emerged from pandemic lockdowns and a surge in demand ran into a wall of supply chain failures and labor market constraints. After aggressive interest rate increases by the Fed and the ECB, among others, inflation has fallen but has not yet reached the 2% goal in either Europe or the United States. At lunch, Lagarde was asked about the idea of moving the goalposts to accommodate that new reality. Like Powell, she said no. We are playing a game. There are rules. Don't change the rules of the game halfway through. I'm not saying that we are halfway through, probably a bit more than that, Lagarde said. Increasing the target could undermine efforts to anchor inflation expectations, she said, and anchor expectations are key to keeping inflation constrained. Mark Yusko shares his views on the keynote speech and also his concerns on the rate hike, the increasing credit card debt, government debt, and what he calls the grand roller coaster of the financial system. As we now get into the video, make sure to like, subscribe, and drop any comments in the comment section below.
I think we're back to normal, but because we were in abnormal for so long, meaning ZERP, that people don't know how to listen to the chairman anymore. They don't know what normal interest rates are. We're supposed to have positive interest rates, right? That's how capitalism actually works, right? There's the promise of earning when you put your capital to work. And so the difference between 5.25, 5.5, 5.75, it's irrelevant. What had to happen and what did happen was we had to get out of ZERP, which was designed to save the bank's balance sheets. And we have to go back to a world where they can actually earn some money. And remember, the Fed only exists for the banks. It is a private corporation, not federal, no reserves. It is a private corporation owned by the banks and the families that own the banks. And its job is to maximize bank profits. So that's what they're doing. And the fact that everybody thinks that they control everything else is why people are missing this fiscal mess. And so the thing I was totally, I won't say I was wrong. I just didn't see it, because it's not like I said the opposite. It's just I didn't say this, which was, if you looked at all the data coming into last year, and we did, right? PMIs were collapsing, services and manufacturing, yield curve was inverted. All these things were saying serious recession. And I said a couple weeks ago, I said, look, I was just wrong. I mean, everywhere I go, restaurants are full, airports are full. I mean, O'Hare was a nightmare yesterday. I mean, it was crazy. People are spending. Well, how the hell are they still spending? Well, it's because the government handouts in the form of disability payments, unemployment payments, all these direct government stimulus programs. And turns out there's still $300-ish billion left in the coffers from the handouts from a couple of years ago. And credit card debt. I mean, credit card debt has gone absolutely, I think it hit $1 trillion for the first time. I think I have that stat right. So I just totally missed the fiscal part, that the government was going to spend their way into oblivion and not worry about the devaluation of the currency, which is why Larry Fink went on TV and said, maybe you should own some Bitcoin. You should buy it from me, but you should own some Bitcoin to protect yourself against currency devaluation. Come on. He said that on television. When you see people reach similar conclusions using different disciplines and tactics and processes, that's when you should pay attention, right? And that doesn't happen very often, right? Because people are going their different ways. But when cross-disciplinary things happen, and this is true of innovation, right? Great innovation happens at the confluence of multiple disciplines coming together. Think about bioinformatics and things like that, and gene discovery. Drug discovery, big data and science and healthcare. Same thing here is when a sociologist can reach the same conclusion as an economist, can reach the same conclusion as an investment person, as an entrepreneur, all kind of saying, something just doesn't feel right here. That's when you should really, really pay attention.
Analysts generally believe the quarter just passed should mark the bottom of the earnings cycle for the broader market. But the economic outlook remains cloudy at best. This week, data showed soft orders for durable goods from U.S. factories in July, and several retailers reported weak earnings. Some investors, though, continue to take comfort from a still tight labor market. American Airlines pilots agreed to a 21% instant pay rise on Monday, and new weekly unemployment claims fell on Thursday. Mark Yusko further shares his view on the stock market and the state of cryptocurrencies as well. Let us now get back into the video.
A couple weeks ago, I wore my roller coaster socks.
Yeah.
That I break out every summer because summer is time for roller coasters. And the thing about roller coasters is there's a lot of ups and downs, but you end up in the exact same spot. We're doing that, right? We have an up,
I agree.
And then we have a down, and then we have an up, and then we have a down. But we end up in the same spot over, and summer doldrums are that. Now, what's interesting about this chart, and I love your point about leading. Someone asked me, why are stocks going down? Right? Stocks are down 5% over the last month. It's a big move. And it seems like they go down most days. Well, it's because there aren't any humans involved. The humans are on vacation, right? We joke at the Europeans, they take August off. Haha, we work so hard. Try to get a meeting with somebody this month. Forget it. I was in Chicago yesterday. I tried to get meetings. 4 people. I'm gone. I'm out. And I don't begrudge them being out. Go on vacation. It's great. But it is fine. So the machines take over, and the machines are pushing everything down. They're pushing everything down. Now, I will agree with you that there was this exacerbation on the SpaceX, news, and there was a sharp drop in BTC. But that's the nature of the beast. The thing that people forget about Bitcoin is it's not really liquid. It's not really deep, because so much of the market cap is hodlers or hodlers, however you want to pronounce it. And they're just not selling at any price. But the same coins churn over and over and over. And that's true of most things, right? Microsoft, there's a whole bunch of people that never sell their Microsoft, and there's stuff that churns. The index funds don't sell their Microsoft. And so when the free float is very small, you can get this is a chart. This orange and light blue line, those are machines. Okay. The dark blue line is humans. That's a human reaction. That's fear. That's a human reaction to a new piece of information. The orange and the blue, like I said, the institutional demand, that had nothing to do with institutional demand. It has to do with machines, with Ken Griffin saying, everyone's on vacation. It's not Ken, it's Ken's massive team. And it's not even really a team, it's robots. So it's the robots saying, okay, we pushed stocks up the first half of the year when no one thought they were going to go up, and we made a ton of money because people were chasing. Now we're going to push down, and we're going to seed the clouds, and they're going to go down for a while. Except for NVIDIA, in theory, right? Which, said, well, we're going to have all this revenue this quarter. And stock popped after hours. But then where did it end up at the end of the day yesterday? It's interesting. Flat. It was up 8% at one point, ended up flat. Stock market crashed yesterday. If you would have said NVIDIA, actually people did say this 2 days ago, if NVIDIA beats, already raised expectations, the market's going to go crazy. Well, it did, but not up crazy. It went down crazy. And we'll see how it levels out today. But that's the machines. The machines, again. And if you look at volumes in the summer, they're really low. So none of this is really that much information. Ultimately, Bitcoin, when the ETF's approved, that's when the bull gets his cape back.
When Michael O'Rourke started describing the biggest technology stocks as the Magnificent Seven in April, the Jones trading strategist didn't realize how ubiquitous the nickname would become, dominating market discussion since mid-May when it became widely used. The group's recent performance, however, particularly the ultimately flat reaction to chipmaker NVIDIA's stunning earnings this week, suggests it could be time for a less glorious-sounding moniker. It seemed fitting when they were responsible for 88% of the market gains. That was a pretty magnificent achievement, says O'Rourke. I don't like talking about 7 stocks every day, but they are still what is driving the market. So far this year, the combined group, Apple, Microsoft, Google parent Alphabet, Amazon, Tesla, NVIDIA, and Facebook parent Meta, are responsible for 3/4 of the S&P 500's gains. It has been a dazzling display. Recently, however, they are not pushing stocks higher. The Magnificent Seven has lost more than $600 billion in market capitalization over the past 4 weeks. Granted, that's only a 6% fall in total, and they are still worth a collective $10.8 trillion. But for the first time this year, they have suffered multi-week falls even as each reported earnings above expectations. Given the continuing dominance of the Magnificent Seven, such a pause in their ascent might not necessarily be a bad thing for the overall market, which is down more than 4% over the same 4 weeks. The danger is that a large part of the group's gains this year have come from expanding multiples, where their share prices have been outpacing earnings, leaving them precariously priced for perfection. Tesla's share price relative to its estimated earnings has tripled this year to a dizzying 60 times, while Apple trades on a multiple of 27, up from 19 in January. Only Amazon has stayed steady at an already punchy 35 times. Even NVIDIA, supported by its hefty upgrades to its expected profits, now trades on a multiple of 33 from 30 in January. NVIDIA's performance this week alone signaled the case for investor caution. After founder Jensen Huang announced figures on Wednesday that blew away already excitable expectations, its shares on Thursday failed to hold an early record high and closed flat on the day. What do you think of Mark Yusko's macro outlook of the market? Please share in the comment section for others as well. Also, don't forget to give us a like, subscribe, and turn on notifications. Thanks for watching.